Hi, this is Evan Hutcheson, CPA. I do virtual accounting for individuals and small businesses, including helping people file their taxes online through screen sharing. If you are in the minority of wanting to file your own taxes, or perhaps you just don't want to give away your information like your social or your bank accounts due to the fear of identity theft, I am here to help. Through screen sharing, I can guide you along the complexities of your tax return from start to finish. Now what I want to do today is show you the S Corporation tax return, the Form 1120S. I'm going to guide you through this, how to input the numbers, what the return looks like, what you need to do. One of the things I'm going to do is show you the financials, how to transfer financials from QuickBooks or another financial system to the tax return. But first I want to just run through really quickly the return itself. It's, of course there's a lot of pages involved behind the 1120S, but the form itself is about 5 pages long. First page has just some general info, your name, your EIN, the date that you formed the S Corporation, and so forth. That's the top of it. Then you get to the income portion and then the deduction portion. Now the deduction has a lot of the main expenses like compensation of officers, rent, taxes, depreciation, and so forth. And then you have another deduction worksheet that just has some of the less common expenses, but they're still fairly common, like accounting, bank charges, dues and subscriptions, and so forth. Now you add up these other deductions with the current deductions, you get total deductions of $484,000, which you subtract that from your income and you come up with your net income, $56,636. Then you scroll on down and you get to a lot of questions they ask. They ask your accounting method, your business activity, if anyone owned 20% or more, or if a corporation owned 20% or more, if anyone owned 50% or more, if you filed 1099s, and so forth. Then you get to page 3. This is the Schedule K. The Schedule K transfers over to the K1. The K1 is what you use to file your personal taxes. So after you file your S Corp, same thing for a partnership. If you file the 1065, your income and some other information is going to move over to the Schedule K, which transfers to a K1 right here, and you'll print this out or send this to your CPA or whatever to input on your personal tax return. So that's this part right here. Then you get down to the balance sheet, which is, this won't affect your taxes at all. This is just kind of your bookkeeping balance sheet. It helps you, and if you earn less than 250 grand or you have less than 250,000 of assets, you don't necessarily have to file this. I like to do it anyways because it just helps me kind of reconcile everything together. But this is your balance sheet, your beginning of the year, so that's pretty much last year's balance sheet that transferred over to the current year, and the current year's balance sheet. And then you have some schedules down below on M1 and M2. But what I want to do is kind of show you, alright, how you get your financials that you get from QuickBooks and how you transfer them to the tax return. So we'll start at the top, at income. And we'll just take a quick look. Here's your balance sheet. It's got your assets and your liabilities and your equity. This is Excel, I know, but I just exported it from QuickBooks. So you have your assets, which is cash, fixed assets, security deposits, your liabilities, which is a line of credit, note payable, and then your equity. Now this is somebody's books who is not an accountant, so hopefully this will help you understand. Certainly if you are not, the best bookkeeper in the world and you have some mistakes, I'm going to look at these mistakes and I'm going to try to fix them as I transfer them to the tax return. So that's your balance sheet. This is your P&L. It's a cash basis, like we saw in the tax return. It was cash rather than accrual. Here's your income, and here's your expenses, and then here's your net income. So what I do is I X off what I've put on the tax return so far. So we'll start from the top. Total income, $539,805. That number there should go right here, 539,805. And this other number right here, this 853, we'll go over that in a minute. That's a little more confusing, and I'll try to make it as simple as possible. But the 539,805 is right there, so we need to X that off. Then we go to the next line item, which is shareholder compensation. Now what I did with this, here's salary and wages that aren't shareholder, here's shareholder. I looked at the W3, which is the summary of the W2s, which has the total amount. Then I looked at the shareholder amount, the shareholder W2, which was 137,605. I just subtracted that 137,605 from the W3 to get the other salaries instead of having to add up every little W2. So I did that, and that 137,605 plus the 45,277 equals 182,882. You see this payroll expense account right here? I took the difference of that, and what do we just added up? I got 14,794, and I input that on the tax return under payroll taxes, because that's just kind of the plug number. That's what's left over from payroll expenses. I'm putting it under payroll taxes. Now, people do things differently. In some returns, I like to make sure everything's good. So I'll add up the 941. I'll look through the 941s and the unemployment quarterly payroll taxes, and I'll make sure that the payroll taxes equal the 14,794. But this is kind of a quick way to do it if you think this payroll expense number is correct. It's all the payroll expenses for the year. Then you can do it this way. Just take this as the plug number and put that under payroll tax. I know we're on cash basis. With payroll, sometimes you want to do payroll under accrual basis, even though you're doing cash basis. I always do accrual. For instance, so this is 2014 taxes, the fourth quarter 2014 payroll taxes. You know, the Social Security, the Medicare, the Tennessee unemployment, in this case, whatever state you're in, you might have that unemployment, and the federal unemployment, all for the fourth quarter were paid in January of 2015. So under cash basis, really that wouldn't be included on here because you're not including it until you pay it. But for payroll, just to keep it consistent, I use accrual basis. That way, the W3 is reflective of accrual basis because it shows the current taxes that are owed for the full year, even though some of those taxes were not paid until January 2015. And you know, January 2014, there were some payments made for 2013 that aren't going to be included on here. So 95% of the businesses I do are cash basis. Most small businesses are cash basis. It's just easier to do the bookkeeping for it, and there's usually more of a benefit tax-wise because you don't have to include the revenues that you've earned at the end of the year that you have not yet collected, which is usually more than the payables that you have incurred but not yet paid. So the taxes are usually going to be higher under an accrual basis. But like I said, I do payroll under accrual, everything else under cash. But anyways, so we're marking this one off. That's on here. Repairs and maintenance of $99. That's down here. Mark that off. Equipment repairs. Taxes of $954 and $350. What does that equal? $1,304. That would go hopefully on here, right here. $1,304. We're marking that off. See these taxes? when the IRS sees it, when you file the return, this smart worksheet is not going to be on there. So all you're going to see is line 12, 16098. This is just a way that you can kind of divvy it out and make sure everything's good. Like I drilled down on that tax expense account on QuickBooks, and I saw that $954 was for state unemployment tax, or not state unemployment, state franchise and excise tax. So I put that under this, and then I put the remainder under other miscellaneous. Depreciation of 3452. Now that is, we'll go over that a little bit more in depth here in a minute. It's not on the profit and loss from QuickBooks. What I do, and what's very important that you do when you export from QuickBooks or when you're using QuickBooks, you need to reconcile to the tax return to make sure everything's good. So here's the bottom line for QuickBooks, $58,879. I'm adding these differences that are on the tax return that aren't in QuickBooks right here, and then I'm doing a sum of all of this to come up with this number right here. So the depreciation was $3,452. It's not on QuickBooks, but it's right here. I'm putting it right here to make sure when we're all said and done that this bottom line number matches up with what we think we should have. 56,636, 56,638. You know, it's $2 off. That's fine. But we know that we're correct. We didn't make any mistake anywhere because it matches up. Okay, now we go down to meals, 863. 50% of meals can be written off. So really we're only writing off 432, half of 863. So we're going to the P&L, we're finding the 863, we're check marking that off. That's travel and entertainment. I drilled down on this travel and entertainment. It's all entertainment, it's not travel. So it's all meals, meals and entertainment. So we mark this off, and then like we said, we got to reconcile to the tax return. Half of it's not deductible, so we need to add half of it back, which is what I did right here. And then we go to the other deduction worksheet. We have accounting of 1,000, bank charges of 35, dues and subscriptions of 196. We're going to try to go through this a little quick because I know it's a long video. So we have accounting of 1,000, dues and subscriptions of 196, and bank charges of 35. Equipment rent of 108,529, insurance of 11,251, and miscellaneous expense of 608. So we have equipment rent of 108,529, insurance of 11,251, and miscellaneous expense of 608. Contract labor of 130,434. Travel of 248. So travel is 248. Contract labor 130,434. Telephone expense of 1553, supplies of 525. So you go telephone expense 1553, supplies. Okay, supplies, cost of goods sold. Evans production, there are no cost of goods sold. There's no inventory of things being sold. So this was misclassified. This is really supplies. So that's 450. And then from the balance sheet, there was a fixed asset of $75 that wasn't a fixed asset. You know, it's only $75. Usually fixed assets are going to be above, you know, $500, for instance. So we move this over to the P&L. So we're adding it to supplies instead of putting it as a fixed asset. And I'll go over that in a little more detail. So that's 75 plus the 450, which is 525. Then we have audio expense of $14,917, audio rental of $10,755, mileage reimbursement of $1,008. So we go back here, we see the mileage reimbursement $1,008, audio rental of $10,755, and audio expense of $14,917. So all these are checked off, which is good. This was the meals adjustment. This was the depreciation adjustment. Here's the supplies adjustment. This balance sheet adjustment of $853, that was on there too. We just skipped over it because I didn't want to go over it yet. But that was the income. We're adding, due to a reversal of AR, which I'll go over, we're adding $853 to income. That's why this is a positive, but these expenses are negatives. This expense is a positive because we're not taking the deduction for it. We're only deducting half of it instead of all of it. But as we saw earlier, it all matched up. This plus these amounts equal this, so we are good there. And then what we do is we go to the balance sheet. So here's the P&L. We go through all those questions. There's Schedule K. Then we're getting to the balance sheet. Now the balance sheet is, like I said earlier, it's not for tax purposes. We put it on here just as informational purposes. So this carried forward from the previous year. This is the current year. Now what we do, and like I said, I think I said this before, we're working with QuickBooks from people that don't use QuickBooks a lot, so there's a lot of inaccuracies, and this is where we kind of make the adjustments. Because the profit and loss statement is what it is. I mean, theoretically, this amount was spent on insurance. I mean, we can always drill down and make sure, but these amounts should be relatively accurate. The balance sheet, on the other hand, these amounts, that doesn't mean anything right there. Negative 2,000, that's not even possible for accounts receivable. Some of these amounts are just off because profit and loss statement that starts over each year. You put the expense in, you put the income in, it's there. The balance sheet is carrying forward value of all your assets and your liabilities, which can sometimes get out of hand if you input wrong stuff in QuickBooks. So we're going to assume that the cash account has been reconciled, because you should always reconcile your cash account. So this 465 will go on the tax return as 465 right here as cash. Basically what we need to do, even if this was right, well, we need to put it on there correctly, but we are not putting these numbers on the return. We're really putting the difference between 2013's numbers and 2014's numbers. So I kind of put 2013's numbers here. I just looked at the older balance sheet and put the numbers here. So the difference between this and this is legit. It is what it is. There's a reason there's a difference. Whatever you input during the year created a difference in those numbers. So that number should be accurate. It might not be in the right spot, but that number is a legit number, and it should go on the tax return somewhere. Now, since this is a cash basis balance sheet, before we exported it, we made sure it was cash and not accrual, because we're doing the return on a cash basis rather than an accrual basis. The accounts receivable and the accounts payable, if you're familiar with QuickBooks, you probably know, those are accrual basis accounts, and when you change it to cash basis, there's a little glitch in the system that sometimes creates these off amounts that are definitely not accurate. Because there's no way there's a negative 2,000 of accounts receivable. Accounts payable had nothing in it, so that's fine. So what we need to do to change it to cash basis is obviously not put this number in there, because that's in no way correct. We look at the difference between 2013 and 2014, and we got to think, okay, accounts receivable gets affected. The other side of the entry, every accounting entry is two-sided. When accounts receivable gets changed, it's the other side of the entry is revenue. So if you're purchasing something as a receivable, you are debiting receivable and crediting revenue. I'm sorry, not purchasing something. If you are earning something, because you're increasing the revenue. When you collect that, when you have a receivable, you're collecting the revenue. And with a payable, it's the opposite. When you are accruing a payable, then that's crediting a payable. You're debiting an expense. Now this is the most confusing part of this video, I'm sure, and I'm sorry. I'll go over this on another video in more depth. I know we've already gone about 20 minutes, so we can't go over this too much longer or I'll bore you guys, but basically, since we are from 2013 to 2014, we are decreasing AR. You see it's being decreased by $853. To decrease an asset, you credit it. So we're crediting, it was credited $853. So we need to debit it back because this is a cash basis tax return. We're not messing with AR at all. So we're undoing what was done to accounts receivable. Since it was credited $853, we need to debit it $853. But we can't just change one account. We have to do a journal entry. We have to credit and debit. Debits and credits have to be equal. So since we are debiting AR back to what it was, we need to credit the other part of that account, which is sales. And that's why we're crediting sales $853, and that's why you saw it on page 1 up at the top and as an adjustment on the profit and loss statement. So it's right here, reversing AR for $853. The fixed assets, these are the amounts for 2014. These were the amounts for 2013. Now remember this one. This was the equipment for $75. You can see the difference in this is only $75. We're not going to put that as a fixed asset. That's just, there's no reason to do that. We're just going to expense it. And that's why we put that under supplies on the tax return, and we also put it under the adjustments right here, the balance sheet adjustments right here. See, here's the revenue, here's the expense that we were adding from the balance sheet. The other two amounts on the balance sheet are on the fixed assets. This $92.14 and this $7,000. See the difference in this and this is $7,000. Those are legit assets. This was a camera for $7,000. So if we go to the depreciation schedule, we can see an asset entry of a Canon C300 for $7,000, and then the GMC van for $92.14. Now with the Canon, you can completely write it off. It's equipment that you can write off. At least in 2014, you could write it off as a 179. The GMC van, you can only write off a portion of it, $3,460. The remaining amount can be or not the full remaining amount, but part of it can be fully depreciated, and then there's going to be a leftover amount. So this amount was 179, so that's 3,460. The full amount of section 179 is 3,460 plus 7,000 from the Canon camera, which equals 10,460. This 179 deduction goes on Schedule K. The regular depreciation that we saw from that van, that was what we saw on page 1 right here, 3,452. Total depreciation 3,452. And that's also what we made the adjustment on the P&L since it wasn't originally on there. So when we go to the balance sheet, when we go to the tax return balance sheet, we have the cash of $465 that we saw. We don't have AR on here because it's cash basis. We just made that adjustment to the revenue. And I'll go over this in a minute. This is the fixed assets. So we increased the fixed assets by what, 9,214 plus that 7,000. So about 16 grand. We increased the depreciation by about 14 grand. So we have left over 2,302, which is the cost basis left after all the depreciation. So if you look at that GMC van, if you subtract out, if you take the full amount, you take out the 179 and the current depreciation, you get this amount right here, which is the amount left over that has not been depreciated. Then we go back to the balance sheet. We see the deposit, which was the same as 2013. So that just goes, that continues on right here. We're going to keep that here. The liabilities and equity down here. This was a payable for some equipment that was fully paid off. This is sales tax payable. It was $848, now it's $932 as of the end of the year. So, you know, it's not in here perfect. As you can see, all these negatives, there shouldn't really ever be a negative on the balance sheet. I mean, unless it's a contra account, which none of these are. This note payable Balboa was negative $3,995 in 2014. At the end of 2013, it was $14,593. So the difference between those is $18,589 payments made to Balboa, and that's why we got rid of that payable right here, because we fully paid it off. The sales tax payable, we're assuming is correct, because in 2013 it was input on the tax return what it was, $848, and the 2014 amount was $932. So we're putting $932 right here. We're keeping the capital stock and the same. The retained earnings, you know, fixes itself depending on how much income we put in the system, and that's how the balance sheet balances. Now, if we go back to this balance sheet just to kind of go over it real quick, we've made this right here, this line of credit. This is his personal line of credit, and he has it in his QuickBooks for whatever reason. So he doesn't, as you can see, the only thing that is reflected on this account are his payments. That's why it's showing such a huge negative. So in 2013 he had a negative $214,000. In 2014 he had a negative $239,000. So he made total payments of $25,000. Since that's personal, since he's making personal payments on, in theory, from a business account, we're increasing this loan to shareholder right here by $25,000. Now, we don't want this to get too high, because eventually he's going to have to pay it back. You know, when the company dissolves, or if he sells it, this is a real liability, or sorry, a real asset, but personally it's his liability, because it's a loan to him, and he's going to have to pay it back eventually. So that's a little bit troubling. You know, we could put it as a dividend and pay taxes on it, but we're trying not to do that, because as you might know, with a corporation, if you're paying dividends, you're paying double taxes. You're paying through the business and through and personally. So we're going to try to pay this back. And what else do we have on here? The other kind of weird thing on here was the this $500 that's no longer a payable. It was a negative $500 payable, but if the retained earnings was also off by $500, so they cancel each other out. So what you need to do is look at your previous year's net income plus retained earnings and make sure those equal your current year retained earnings, because retained earnings is your previous retained earnings plus or minus your net income. So his previous retained earnings plus his 2013 net income equaled this amount, which is $500 more than this. So we're off. And this is $500 more than this. This is $500 less than this. So I looked back at QuickBooks, I did an audit trail, and realized that there is a $500 payment entry made in the QuickBooks after we printed out the 2013 balance sheet. So basically, in like June of 2014, someone went back to 2013 and made an entry, which is what you should never do. You should never go and make an entry way back then, because that's just going to screw things up, as you can see here. But we just canceled both of these out. We didn't make an adjustment to the payable right here. You know, like up here, this receivable, we had to credit sales. We would have had to credit supplies supplies expense or another expense right here because of the difference, but we found it down here, so we're not going to do that. It's going to fix itself. So this has been 30 minutes. This has been a 30-minute long video. So I'm sorry about that. I hope this helps out a little. I want to go over it, and I want to go over the return itself in way more depth, but I know 30 minutes is a long time. Just real quickly, I'll say some of these expenses down here, most of these are going to be no, but you're still going to have to read through them because there's always the chance that it could be yes. This one right here is just, did you make payments that would require 1099s? The answer is yes. Did we file them? I sure hope we did. The answer is yes. With some of these, this is at the end of the tax year, did the corporation own directly an interest of 20% or more in another domestic partnership or a trust? So you just kind of have to read through these and make sure that you're good on these. It's usually going to be no, but there are definitely occasions when the answer is yes. So just make sure you look through them. They're not as daunting as they seem. But you know, after all said and done, like I said, this 56793 transfers over to that Schedule K, which is right here, along with the 179 that was not in the depreciation number. It's only on here. So those two numbers are on the K1, which is what you use to file your tax return. So I hope that helps a little bit. I know it's kind of confusing. I'll try to do another video explaining more of the accounting part of that balance sheet, because I know that can be really, really difficult to understand if you're just learning it. But anyways, like I said, if you have any questions, you know, contact me. I'd be happy to work with you and either file your taxes for you or kind of train you as you go through them. So I hope to talk to you soon. Thanks a lot. Bye.